WeWork once sold itself as the future of work. Investors treated the company like a technology platform, not a leveraged office operator. At its peak, private markets valued WeWork at roughly $47 billion. 4 years later, the company filed for Chapter 11 bankruptcy protection. From the outside, the collapse looked fast. In reality, the warning signs were inside the model long before the IPO failed. At the center of the story was one seductive claim: offices could scale like software. Adam Neumann and Miguel McKelvey built a powerful growth narrative around community, flexibility, and design. That pitch landed at exactly the right time. Companies wanted shorter commitments, nicer spaces, and a more modern office identity. WeWork packaged all of that with venture-backed ambition and brand theater. Then SoftBank poured in billions and pushed expansion even harder. Scale became the strategy, and growth itself began to look like proof. The brand got bigger much faster than the economics got better. But the business model was never as flexible as the branding. WeWork signed long leases and then sold short-term memberships. That mismatch made the company highly exposed to vacancies and downturns. Every new location also required major upfront build-out spending. Revenue could rise quickly, but so could losses and future obligations. The company called itself a platform, yet the economics still depended on real estate discipline. Growth covered the gap until growth itself needed to slow. The 2019 S1 forced public investors to look past the branding. They saw huge losses, aggressive assumptions, and complicated related party deals. They also saw governance built around Adam Neumann rather than investor control. The filing exposed how much of the story depended on adjusted metrics and future promises. Suddenly, the market stopped paying for vision and started pricing risk. The planned IPO unraveled within weeks. That shift changed everything about WeWork's access to money. Stepped down, and SoftBank stepped in with emergency financing. That rescue prevented an immediate cash collapse, but it did not repair the structure underneath. WeWork still carried lease commitments built for a more optimistic world. Then the pandemic slammed office demand and made the deal even harder to defend. By late 2023, the company entered Chapter 11 to cut debt and restructure leases. Bankruptcy was not one bad quarter. It was delayed recognition. The market had finally run out of reasons to suspend disbelief. WeWork's story is not just about a charismatic founder behaving badly. It is about what happens when capital markets reward narrative faster than unit economics improve. Scale can amplify a weak model just as easily as it amplifies a strong. Brand, design, and growth can attract attention, but they cannot erase structural mismatch. Once public scrutiny arrived, the gap between story and business became impossible to hide. Public markets did not kill WeWork, they simply priced it more honestly. That is why WeWork remains one of the clearest warnings of the last startup cycle.